So hello and welcome you to Trading Spotlight today on Wednesday. It's the 7th of August 2019. Yeah, I'm to some extent really excited to give the webinar today, since it's my first one with this new series. And the topic is in fact a very special one. It's called An Introduction to Trading Psychology. I hope that you'll enjoy it. And first question, can you see my screen? So can you see the screen with the Admiral Markets logo in the upper left and the text Introduction to Trading Psychology? That would be nice to know, but I think usually think this should be fine. Everything should be fine. Okay, great. So yeah, it's in fact a very spectacular topic, one I really like to talk about the most here. As usual, we want to start with a short agenda in this regard, and probably today's agenda of what we want to look at here. So first of all, sure, we want to give a short introduction to the topic in general. I mean, I think everyone who is familiar with trading, so even if you're a beginner, you might have heard in the past already that trading is a lot about psychology, and we want to give some deeper thoughts why this is the case, even though it's not only psychology. So I, for example, don't like the quote anymore, trading is 100% psychology. Yes, it's a lot psychology, and you can break lots of topics down to psychology, but in my trading, and based on my personal experience, I can say that trading is, or profitability in trading is built on 3 columns, and trading psychology is one of them. But if you're not familiar or an expert on the topic like risk management, or you can be as mentally stable as you want, if you do not have a trading strategy which gives you an edge, you won't make it in trading. You can be the greatest psychologist in the world, but this does not necessarily mean that you make it as a trader. So trading is not 100% psychology, even though you can break many topics down to psychology and find potential reasons why this or that might happen, might affect your trading in one or the other way. So then we'll look into the 4 steps of learning and Dunning-Kruge. This is a very interesting concept. You might have heard about this, and we want to dig a little deeper into this matter here during the upcoming 45 minutes. Then we'll look at something which is, I think, very interesting for many. Some of you might have heard in the past that once you get emotional in your trading, or you give, or you let emotions access your trading or your trading process, then you won't make it, because emotionally affected traders are not likely to make it in trading. The thing is that if you're not emotional, which is, by the way, absurd. We're talking about human beings trading the markets, and we are emotional. We are an emotional species, if you want. So to think that traders do not have emotions is definitely something which is not true. And in fact, we can show, and this is where Yerkes-Dodson comes into play then, and the zone in this case, some of you might have heard about this level of optimal arousal, let's say, in which you just be and trade your way, that this is something which needs emotions to reach this zone. And Yerkes-Dodson shows this from an academic perspective, even though from a quite interesting and also understandable perspective. And then the next question is, what could your personal trading routine look like? So I really appreciate to have a clear routine I follow every day in my trading, and I want to give you some thoughts on this, some steps you can follow here, and based on which you can build your own personal trading routine. It's a very individual thing. I think this is sure that that becomes clear. So everyone has a different approach to enter the markets, but not only that, but to enter each day, and needs while one, for example, needs to take a walk or to jog around the block for 30, 45 minutes or something in the morning to get to a certain level to perform well. Someone else has to stand on the balcony or in his garden and smoke a cigarette and have a black coffee, deep black coffee, but then can start the day from there. So it's a very, very individual process, and this routine here will help you to adapt it accordingly to your personal needs then. Yeah, and then sure, you want to answer the question, that's one of the main reasons for this webinar, how to profit from this new knowledge in your trading then. So yeah, the next thing, this is something about me. I'm not really sure if I need to introduce myself. I mean, sure, I'm Jens Klatt, and here are some key facts about my career in the financial markets, how I got started. Probably what's more of interest is that before we kicked off with this new series on Monday already, together with Paul. If you remember, probably have seen it. If not, I highly recommend watching the recording then on YouTube, on the YouTube channel from Admiral Markets. We had an interview series, and in this context, I recommend the following link here. Just let me give you the link here so that you get a better, I call it Jens interview in the chat box. And oh, one second, by the way. Let me just, I just saw that I didn't send it to everyone. Here, there we go. So yeah, please feel free to read the interview, and then you probably get a very good idea of where I come from and what connects me to the market, what fascinates me in all this. And not only the great things, but also those which were how can I say, which made me the trader I am today, risk averse to some extent. In regards to Admiral Markets, I also recommend to check out the website, admiralmarkets.com. Admiral, I guess most of you have probably learned about this already when entering here the details around this Trading Spotlight series, webinar series, that Admiral is Forex and CFD broker with way over 8,000 financial instruments, licensed by the FCA, by the SISEC, but also by the ASIC, for example, in Australia, with a very competitive offering. What's probably of interest in this regard is that I'm located in Germany, in Berlin. There's also one office here, German-speaking office, and we in Germany refer to Admiral usually as the so-called DAX expert. So it's a very, very competitive offering compared to all the other brokers, with a spread here of 0.8 pips during the main trading hours. What's also very interesting for short-term traders, especially when scalping the DAX, for example, the spread is a very important aspect in this regard, especially when it comes to tight stops. There's also an offering, Admiral Prime it's called, it's 0.2, and the DAX then, the spread, and on top you pay the commission of 60 cents per CFD traded. So that's probably definitely one reason alone. On top of that, there's also this competitive, very competitive offering in FX, for example, to give Admiral a deeper look. On top of that, sure, from a regulatory perspective, there's also the risk disclaimer. But we want to have a look here now at the topic of this webinar, the introduction of trading psychology, and let's call it my 3 columns of profitable trading, even though I have to say I think that many others are probably profitable traders consider those columns to be to be general and worth noting. So the 3 columns that profitable trading is built on, I've already mentioned them. In fact, it's one column is risk and money management. The next is trading psychology, topic of today's webinar. And then we have the strategy with the edge. And based on that, we have our, let's call it roof on of profitable trading then. What's now interesting is, and this is also something I mentioned already, if one column is missing, then usually you can't forget being profitable in your trading. Some of you might probably think, okay, is it really the case? Therefore, I'd like to give you a small story, yes, of a student of mine who said, okay, Jens, I trust you. He listened to several webinars with me. He watched me trading. He read my books. So it's a German student in this case then. And he said, well, I want you to become my trading coach. And when we came to the topic of trading psychology, he said, well, can we skip this? And I said, no, we can't. But please tell me, why do we want to skip this? Well, he said, I mean, at the end of the day, if I have a strategy, you give me now as my coach, you give me the strategy with the edge. We have some risk parameters to it. So something like rule of thumb, never risk more than 1% per trade. And then there we go. I just click on the button and I trade it through, and everything's cool and everything's fine. And I will make money, right? Because of the fact, and this is where mental stability comes from, I know that it works because it works for you. I said, yeah, this is very interesting because this is not the case. And this is something you will find out very soon. And in fact, even though he didn't believe me at that day, but around 1 year, took 1 year. And we, by the way, just to make long thing short, we didn't skip the trading psychology aspect. But 1 year later, he called me on a Saturday. I was just having a walk with my wife and my kids, and my phone rings, and he's there and tells me, okay, well, now I know what you mentioned when you said it just doesn't work. Having a profitable strategy, known profitable, proven profitable strategy, having the right risk parameters, but at the end of the day, it all comes down to the mental aspects of trading. And this is also something, it's not just one story I could tell you. You can see the same story, for example, when looking at the turtle traders. Some of you might have heard the story about the turtle trading. Some of you might have read the books from Schwager, Market Wizards. There's also Richard Dennis and Bill Eckert, both of whom ran this turtle trading challenge. And they also say, well, we gave our attendees of this project, we gave them a proven profitable approach. Some of them made it and became millionaires, very famous and successful traders, hedge fund managers, and all this. And some of them just doesn't. And where's the difference? All of them had the same strategy. It came down to trust in the strategy, for example, which is a mental aspect. If you do not know what you're doing, then it's very difficult to come up with topics like, for example, inducing rationality. In my case, for example, several weeks ago, it was around the ECB decision. With all strategies I ran on the FX and also on the equity markets I traded, I had 5 trades open. It was small trades, was risk parameters were fine, were balanced according to the overall portfolio I was trading. Everything was cool. 5 trades, all of them were stopped out. I got hit on the wrong foot on each trade. Okay, while I felt uncomfortable with that, but I didn't feel uncomfortable from a money perspective, but I felt uncomfortable for being on the wrong side, being caught on the wrong side, and not having the right idea about the ECB and how it might affect, even though at the end of the day, once reading my research, you will find out I had a quite clear idea of that. Unfortunately, I was just triggered into a trade, which I didn't want to have at the end of the day, but this is when it comes to strategies, and you let the systems, the signals being generated in an automatic way, so you do not have a chance to intervene here. Just know you're trading a proven profitable strategy and you have to take the trade no matter what. And so it came down to losing on those 5 trades. It just happened. And at the end of the day, I kept on trading with no big problems, because I, at the end of the day, said, okay, that's it. 5 trades, 5 losses, fine. Keep on trading. After 1 week, I had made back all those losses, plus on top something positive, or some small amount on top of that. And this is something which you can only do if you know what you're doing, and if you know what those strategies you're trading are about. If you do not know that, you can't really trust them, and then mental instability comes, risk aversion hits you, uncertainty, and all these affects emotions, in this case negative emotions, which won't let you profit, or which make it nearly impossible to profit from the overall positive expectancy in your traded strategy. And that's how how these columns are or interact with each other. I nevertheless want to show you some ideas so that you grasp how these columns interact strongly with each other, and how they are dependent with each other here in this case. So I've taken only 2, and this in regards to trading psychology, since this is today's topic, is risk money management and trading psychology, for example. Everyone knows that. Everyone knows that. it's an inadequate position size, which affects the mental stability in your trading. And what do I mean by saying, you know what I'm talking about? Just take a position which is too big in relation to your overall portfolio. So if you have a portfolio of, let's say, 10,000 euros and you're risking 1,000 euro, 10% of the portfolio in one trade, you definitely feel uncomfortable having this position. You probably feel great if the trade works out, but let's assume you have the position and the strategy says to generate an overall long-term profitability and positive expectancy of the strategy. You have to, for example, risk 1R. In our case, then 1R means we are risking 1,000 euros, even though it's too much. But let's assume that this is our R, and to have the strategy play out the positive expectancy, we have to go for 2R on the upside. This is our potential target. So now let's assume the market moves, let's say, half an R in our direction. That's 500 euros. In comparison to what we have in our trading account, this is 5%. This is huge. There's tons of performance, and many fund managers will be jealous of your performance here. Even though if you tell them how risky your trade was at the beginning, they will just say, okay, then this performance is not as well anymore. But now the thing is, profitability won't be given anymore if you're saying, I take now the gains of half an R here, 500 euros. While in case of being on the wrong side of the trade, you may be sitting completely paralyzed in front of the screen, and you're probably not taking the loss, even not if 1R is reached, because you say, well, I'm usually going half a month or whatever. I have to go to work to make this money, to make ends meet here, and now I'm losing this within several minutes, probably hours of trading. I just can't take this loss, and rather sooner or later, I mean, the market can't push to zero here, so rather sooner or later it will turn around. And this is exactly what I'm talking about here in regards to risk and money management, knowing yourself, trading psychology, but also what is an adequate position size for you. And also in regards to the strategy you're trading, the risk parameters, and the combination of both you and the strategies you're trading, and then put a percentage in front of it, how much risk you should take per trade. Yeah, and this is something which perfectly illustrates, I think, where risk and money management and trading psychology interact strongly with each other. But in addition to that, there's also trading psychology and trading strategy with an edge. Even though I've already mentioned this, so we make long things short here. After facing 2 or 3 losing trades in a row, you start to look for another strategy. This is the strategy hopping, which is usually happening. Therefore, a different story. I had a webinar, where it was one in my series, in fact, where I was live trading the US market opening. Why I refer to that is, by the way, that one of the webinars in the upcoming weeks will make this strategy a topic here on the S&P 500, in fact. And I was trading this US market opening based on the strategy. We can show that it's proven profitable over a very, very long time span. So there's no need to worry. Yeah, it's just great for illustration purposes, especially to show how such a backtest should be, and then you trade it in a real market environment. And the only problem with this webinar series was that I was having this webinar only once a week. So that means you take the trade and you have a hit rate of 50%. So which means nothing more than you have a 50% chance of winning and a 50% chance of losing, and that's only once a week. So, which means nothing more than there will be weeks when you have, on average, probably 2 winners, and then you have 3 losers, or you have 3 winners, 2 losers, and somehow it balances. But there will also be times when it's 5 losers a week, or it's 5 winning days a week. So it's like at the end of the day, at the end of this test, you will see it's somehow balancing around 50%, slightly below that, by the way. So I run this webinar series. I run the live tradings, the first 4 events. So at the first event, there was lots of people showing up. So really lots of people. And you saw after the first event and the losing trade, the attendance rate dropped. And it kept on dropping because the next week I held the webinar, I was in a losing trade again. And then the week after that, it was a losing trade again. And after that, 4 weeks, had a losing trade again. The funny thing about that was that if you calculated all winners and gains, because you're trading this not only on one day, but on every day, so Monday to Friday, not only on I think the webinar series was on a Thursday or something, you could see that we were already ahead. And after 6 months, we were definitely ahead of that. Still, people just do not trust the strategy. They just don't trust the strategy that it could work, especially since it's a quite easy one. It's following 3-4 predefined steps, and many can't just really think that this strategy will work out in the long run. So if you can't build this trust because you haven't worked on that, you haven't run the back test, you haven't seen the key parameters work in reality and under real market conditions over a quite long period, minimum 6 to 12 months, you can't trust it. It's natural. And you face 2, 3, 4 losing trades, you just leave the webinar, or you just skip the strategy and say, okay, this doesn't work, especially not for me, so I need another strategy. And if you do not have this trust in the strategy, where trust comes or equals mental stability, respectively trading psychology, you will rather sooner or later find out that this is definitely something, or these two strategies, or not strategies, aspects, these columns, which play with each other and interact very strongly with each other. This is, by the way, also the same as with the student I was talking to before, and where I know that this just won't work. If you don't know what's in the strategy, if you haven't seen it in reality, forget about it. It's simple to give the strategy away, but it won't work for you in the long run if you do not take the necessary steps to adapt the strategy to your personal risk profile. It shouldn't be the other way around. So then I've now referred to something which is known as loss aversion. So some of you probably have heard about this. The thing is that I usually I mean, at the end of the day, everyone knows what I'm talking about. When let winning trades run, let losing trades cut them short. Everyone really knows what I'm talking about here, because you can read about it in books. Everyone knows with some statistical background or mathematical background, everyone knows that this comes down to the formula around the expected value. And so everyone somehow knows that in trading, it all comes down to let winning trades run and cut losing trades short. The only problem with that is you just hear about it, you take it, you know it, to some extent you know it, but if you haven't really felt how it feels, then at the end of the day, the problem with that is that unfortunately, you don't really understand what I'm talking about. But if you connect some kind of feeling to that, then at the end of the day, you start to understand better, and you probably take steps to overcome this. And therefore, I'm usually doing the following, and I'd like to play a game with you here. So it's 2 games. They are independent from each other. And I like to choose you between those 2 options, and type in A or B in the chat box then. And then I tell you if this is the example, which if this is what I expected it to be or not. And I can already say in 4 weeks from today, or it's not 4 weeks, but it's 4 weeks plus 2. So usually I'm the Friday host for this Trading Spotlight series. I will give you some deeper thoughts into that, and then I show you that this is obviously something which affects your trading, and why this is of high interest for your long-term profitability in trading. So game 1, you please choose one of the following options. Option 1 is you get right here from me 900 euros. Okay, you just get 900 euros. That's it. Every attendee here gets 900 euros. That's it. Or you have the chance to make 1,000 euros, but in 10% of the cases, you get nothing at all. So it is as if we never played this game before. I take my money, you leave with nothing, I have nothing. Or I have my money, I keep my money in this regard. So the question now is, which option do you choose? And now I just ask you to please type in your answer into the chat box, just A or B. So we wait for, let's say, 10 seconds or something. So now we have, I think it's BBAA 3, now 4-3. Okay, so let me just count. Let me just count. So it's 4, 2, 2, 5, 6, 3, 3, 4, 3, 4, 4, 6, 4, 6, 5. So there's a slight tendency. There's a slight tendency to A right now. Slight tendency. So what I can tell you is, if I was now in front of an audience and I had, I don't know, someone right beside me, I would have written down what I expect the audience to say in case of game A, wrote it down, and then just handed it over. And after we played the second game, would have taken this small piece of paper and showed it to the audience. Then I will just let you know how I would play this game in front of an audience, not in a webinar, and let you know about what I think. So there's a small tendency to A then, okay? There's a small tendency to A. We can see this. Let me just now present you game 2. Now we play this game with losing. And now it's not that I give you 900, but every of you gives me 900 euros. So you lose right here 900 euros, but that's it. Or you have a chance of 90% to lose 1,000. But in 10% of the cases, you're not have to give me anything, and we're just leaving it that way it is. You take your money, I have nothing, and that's it. Which option you choose now? A or B? Okay, did I miss an A? I just see, I only see Bs. Only Bs. Ah, there's the A. Okay, perfect. So let me just count now. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 1A, 11B. Okay, so now you have to believe me, but I'll give you the explanation in details in the webinar around behavioral finance then in around 3 weeks, 4 weeks from now. I can tell you this is not a surprising result, not for game 2, but also not for game 1. In case of winning here, there's this small tendency to take the safety version and just grab 900 euros and that's it. Don't play any games and risk here of not getting anything at all to only make 1,000 or only make 100 euros more. While here the option becomes that you say, well, if I lose 900 or 1,000 doesn't matter. But the great thing about game B here is that I have a 10% chance of not losing anything at all. So usually in the so-called prospect theory, it's based on some thoughts from Daniel Kahneman and Amos Tversky. I highly recommend reading the book Thinking Fast, Thinking Slow in this regard. You will find out that the results you have here, just screenshot the chat box and find out what both these guys write about this in their book. It's a bestseller, by the way, and Kahneman is a Nobel Prize winner, so it's a highly recommended book from my end. They usually say in game A, or game 1, the guys choose in 60, probably 70% of the cases, depending some kind of the risky version of the attendees. They choose option A. We had 6 to 5, you remember, and in game 2 we had now 1 to 11. 1 option A, while 11 took option B here. There's usually a 90%, probably also higher than that, chance that exactly this happens, that most of the attendees then choose option B. You can find out in both ways here, and you can calculate it, the expected value. It's only mental. The expected value of both options is identically in both cases. It's equals. The expected value in option A in both cases is 900, respectively minus 900 euros. While 90% chance of 1,000 is 900 minus nothing, respectively minus 1,000 multiplied with 0 minus or plus 0 isn't minus 900. So both cases, mathematically, the options are the same. So you're just taking the reason for your answer based on your emotions in this case. And this is because we are risk averse and we try to avoid losses, and we try to avoid pain. And there's a academical aspect to that, which here delivers the reason why it is so difficult for especially retail traders to cut winners short while letting while it's so difficult to let cut losing trades short and let winning trades run. So that way around. And this is perfectly illustrated here in this game already. Again, we'll dig into this in a webinar 4 weeks from now. And it's a highly fantastic and interesting topic, by the way. And I highly recommend joining this webinar too. But we want to focus now on the 4 steps of learning. So it was only a game I wanted to play to just make you feel that there is definitely something in regards to mental stability when it comes to trading. So we want to look at the 4 steps of learning here. And I'm someone who recommends everyone to formulate a mantra in regards to your trading in general, to your daily trading routine, and which makes it for you possible not only to reach your zone, which we will see later, but also to reach the level of so-called unconscious competence in your trading. So which means trading then from your zone, just from the state of being, and that you don't need to think anymore about where you stand in a trade, why to enter the trade or something. It's just an automated process. You just enter the trade based on your pre-defined set of rules. You follow these rules. You know it has a positive expectancy, not only the strategy you follow, but also the rules you follow in regards to get to your zone and to become confident in your trading every day and become stable in your trading every day following this routine. And then you just keep on trading and knowing that the overall results of your trading long-term is the result out of all trades. It's not only one trade. So to give you a better idea of that, it's like the question you want to answer is, do you really want to go for the breakout here or not? If we can put a likelihood of the market then moving another 100 points, reaching your take profit level on the upside, and we can put a number on that and say in 70% of the cases, you're reaching those 100 points and making 100 points more, it's probably worth to go for the breakout and being not negatively affected from a mental perspective in those 3 cases which we did not break out. It's only 30% of the cases, and we're only, let's say, losing then kind of 40%. And this is, or 40 ticks and something like that. And this is what I mean with all trades, consider all trades. So because you know this happens over and over again, and the likelihood of here getting 70 pips in case of getting 100 points in 70% of the cases gives you a positive expectancy with such an approach. To believe that, it makes it necessary and really to repeat that over and over again, like driving a car, for example. This is where it comes then to reach the level of so-called unconscious competence. You just in this state. So these 4 steps of learning are those 4. It's unconscious incompetence. That means you do not know nothing at all about trading. You just enter the trade and you just hope that it plays out or not. It can't be so difficult to buy low and sell high. That's usually how it works in reality. When especially someone who is somehow infected by the let's call it trading virus, he just wants to trade and he thinks this is great. So having seen some kind of documentary or film like Wall Street or something, and just thinks, wow, this is trading. This is exactly what I want to be. And I skip my job. I just leave my day-to-day job, and I want to trade 100% of my time because I think this is what I want to be in. And then I download the demo platform at a broker of my choice, at the broker of your choice, Admiral Markets, and then you download the platform, you trade, and you just enter the trade, and you don't know whether it's good or not. The only problem is, in case of downloading the demo and seeing, let's say, 5-10 trades play out and make money with that, you're very, very fast in opening a real money account and do the same again. And you keep on doing that as long as you haven't had any pain connected to trading. And the moment you have a losing trade, this is usually the moment then when you realize that you're conscious and competent. This is the moment when you realize, okay, obviously I don't know what I'm doing and I have to overcome this. And then you start to work on it from a perspective you've probably learned in school. You have to study everything. You buy tons of books. You read every book on every indicator, on every analyzing methodology. You're scrolling through forums. You're discussing the markets. You're checking social media, new trading tips, and everything. And you try to get your hands on anything in regards to trading. It's because you think the more you learn, the better you become. This is usually right when it comes to school, but in case of trading, it's the complete opposite. Usually at the end of the day, and this is especially when you're here at this state of unconscious competence, you know, the lesser indicators you have in your chart, and the purer, let's say, your chart becomes, the cleaner it is, the cleaner it looks, the more chances of success you have. It's very, very difficult to formulate this right now, because there's certainly approaches which are very, very indicator based, let's say, and there might be traders out there who use lots of indicators and are still profitable, but still it has to somehow fit your personality. And I, from my personal experience, know that many of those who are profitable trading in the markets are not looking at the Bollinger Bands or MACD or RSI or something like that, or trend lines, but they're more focused on the price action itself. But let's come back to the conscious incompetence. So you find out, okay, it doesn't work. And at the end of the day, it's like, by the way, I just, probably it's better to switch over now here to the next slide than already, to the Dunning-Kruge effect, and use this one here as an idea. So this is the stadium of unconscious incompetence. This is where you just download the trading platform. Probably a real money account is open very, very quick. And then you have first 1, 2, 3 winning trades in a row, and you think you're the best trader since Jesse Livermore. I think you know this. The biography of Livermore is written down from Edwin Lefebvre, also a highly recommended book, one which is also recommended from very successful hedge fund traders like Paul Tudor Jones, for example. It's called Reminiscences of a Stock Operator, highly recommended book. And yeah, so you think you're just best trader in the world, and then it seems as if trading is not as easy as I thought. You switch over to the stadium of conscious incompetence. So realize, okay, I don't know anything about trading. I have to learn. You learn, you don't see, and you learn lots. You spend lots of time in trying to become better in your trading. The only problem is you don't become better. It's not that your equity grows, but instead it probably stabilizes, but it's still, there's this tendency to see it, to still see it dropping. This is the moment then when you, where there's 2 ways. One is to just say, okay, I'm not trading anymore, or you try to improve to overcome this. Nevertheless, it doesn't matter if you take this or this path. There's definitely it's quite often, let's say, that there's the saying that all these experts out there writing books on trading or having some kind of signal service or whatever, or have to give coachings, that they just have to give that and try to make money that way, since they can't make money in trading, since it's not possible to make money in trading. So this is then here where one says, okay, I just leave it, or you say, okay, I keep on. And then you start to realize rather sooner than later, also probably by listening to the right persons, let's probably assume that, then you realize, okay, this is the way how it works. And then you find out, okay, for example, automating your strategies and not double checking everything anymore, but just enter the trade when the signal arrives, take the trade, and the only discretionary intervention, for example, is by trailing the stop manually, or probably fully automate your trading to get emotions completely out of it and work with predefined levels where you say, okay, here's the stop, there's the take profit, now make or break it, and at the end of the day, if it hasn't reached the stop loss, haven't reached the take profit, I take out the trade wherever it trades, and then next day I trade it again. This is then when you start to automate the process and where you start to follow a preset rules, predefined rules, and where you then see, okay, this is how positive expectancy, especially if you trade with a strategy with a positive expectancy, this is then where you realize, okay, this is how it works, and then you stabilize, and the equity starts to slightly grow. And you start to get a feeling for that, and this is then the moment of conscious competence. You realize, okay, wow, this is how it works. But still, you realize, okay, it makes sense. Still, it's here. The journey is the reward. So you still are not in the region where it's unconscious competent, where you just enter the trade and are not affected by any negative emotions attached to that. So I just, by the way, you probably listened very carefully to what I said at the beginning in regards to those 5 trades which were stopped out around the ECB. For me, it's still something which it's not emotionally affecting me in a very negative way, let's say, but still it affects me to some extent. I think about it. I just like, not sure, where's the mistake? Where was the mistake? Was there a mistake? So probably there were signs where you say, okay, I probably should have skipped the trade, whatever. This is what arises and is still there. But the good thing, at least, is that I'm not thinking about it in a monetary perspective anymore. So I know it's money I put on the table, and I've lost it. I've lost it the moment I took the trade on. If I can take back more, or at least a small piece of what I put on the table at the beginning of the trading day, great. But still, even if the money is gone, it does not affect me anymore. But still, there's some kind of thinking about it from time to time. And this is what I mean with the journey is the reward. You can still improve and then optimize and try to smoothen the equity curve. And this is how those 4 steps of learning and Dunning-Kruge perfectly play together with each other, I think. Yeah, and so now let me introduce to you to something I mentioned at the beginning, the so-called emotions in trading. And I already said that emotions are crucial for your trading performance in general. And again, this is no coincidence that there's this sorry, I forgot the German word. The German word is Fragezeichen. It's question mark. Yeah, thank you. Question mark. Emotions, the question mark is no coincidence here, because they are necessary to perform well in your trading in general. And Yerkes-Dodson here delivers the answer, which means you have to support the positive emotions while trying to reduce the impact of negative emotions. For example, what I just said or referred to, when it affects me in my trading and I think about it, it's a positive. I consider this to be a positive emotion, because the emotion tells me, okay, there's something wrong and you have to think about this. And then I try to adapt and try to somehow find a solution to the problem, for example, to my research skills, or a good solution to probably skipping the trades in the future then. And then, on the other hand, try to make those negative emotions small. Just accept, for example, the fact that trading is a game of winning and losing. And at the end, you have to bend the edge your way, and you have to make sure that winning trades are on average bigger than losing trades, and thanks to the hit rate you can overcome then this negative expectancy and turn it positive for you. And in this regard, again, here the Yerkes-Dodson model comes into play, which is, I think, a very great way to illustrate what it takes to come to the zone here, this region of optimal arousal, which you can find here. So you have arousal which is low here at the left side, and then it increases. It increases and increases till it turns to stress. I usually do the following. I try to explain it in a way where I say, think about an athlete here. He has to warm up to reach a certain level of arousal, and then his muscles start to perform really well and interact really well with each other. And he is capable of reaching a high level of performance, a high performance level here. in this regard, the highest in this regard, by the way. While if he overpaces during the warm-up and he exhausts himself in a very, very dramatic way, let's say, well, the performance then starts to drop again. So what's your target is to find a way to increase your arousal level and to bring your emotions, or to play with your emotions in a way, let's say, to make sure that you reach this zone of optimal arousal where you just be in the moment and you keep it here. The only thing with this is that the problem which is attached to that is it needs not only lots of practice, but it also needs, for example, a proven profitable trading strategy, something you can really trust. So if you do not have this, it becomes really, or if you do not know, let's say, the key parameters around your trading strategy, it becomes really difficult to keep you in this zone, because there's now a technique, for example, we can call this inducing rational thinking. You can try to keep you here in this zone by knowing, for example, that a loss is only that. It's a loss. It's part of the game, let's say, or it's part of the strategy. If you have a hit rate of 50%, let's say, you know that 50% of the cases you will be on the wrong side. So 1 trade, 2 trades, 5 trades won't affect you in a very, very negative way, because you know they're just part of the game. And thanks to simulations, for example, you know that these periods of losing streaks appear. And you can't do anything about this, but just accept them as part of the game and part of your long-term journey to success in your trading. And but by knowing these parameters, you see, then only then it is possible to keep you here in this zone of optimal arousal in this case. So while becoming then, or in poker, for example, you sometimes talk about going to tilt, which means like you have a high stress level and you start to overtrade. You take signals which are not system based anymore, but you try to make back losses from before, revenge trading, for example. This is then where you have definitely a high arousal, but it's a stressful environment in which you find yourself in, and where the performance dramatically drops. Sometimes this is also here the region where then the trading account goes bust, and where you just squander, I have to say, squander away all the losses and all the hard work you put in here to reach new equity highs then, because you just can't really cope with your emotions, negative emotions in that way. And this is then where stress arrives and leaves you vulnerable to significant losses. So let's come here to the daily trading routine. Unfortunately, I just found out, but unfortunately a little too late, that here we just somehow lost this a click. So a click and then the next point arrives. But still, I think it's good enough to get an idea of how your daily trading routine should look like. So what I write here, a known concept, it's in fact nothing special. So I didn't invent, or I do not plan to invent the wheel anew here or something. It's a known concept. Everyone knows about that. Unfortunately, or funny enough, or whatever, not many let this routine here become part of their daily trading routine then in this case, which is funny, because having these clear preset rules here can in fact give you an edge you're looking for in your trading. So I say you need a daily routine in your trading by writing down a clear plan which you follow every day. Okay, every day. So many try to escape this 9-to-5 job and think that trading then leaves them with all the flexibility and freedom they are looking for. What they don't see is that trading, in fact, is only possible to be a profitable profession, and in the way to make money, the only way to make sure that this will really happen, you make money and take money out of the market, is by following rules, daily routines, which are probably even tighter than the rules you followed in your 9-to-5 job. So this is definitely something to consider, worth considering before making such a step. So I refer to this then here, inducing rationality especially. I'm not referring to the crawler concept in this case, but these techniques, they aim to deliver short-term solution for mental instabilities, and it becomes only possible if you have, again, a clear daily trading routine, and a proven profitable strategy where you know all the key parameters on your trading. If you do not have this, you won't, these techniques won't work, or to just some extent, which probably at the end of the day won't make you, won't give you the help you're looking for in your trading, or the steps you want to take forward in your trading. So we all start with a preparation, okay? The target is very simple, and everyone can grasp this concept easily. You make sure that you start your trading the optimally prepared and focused. So the warm-up is key. So what I'm talking about here is warm-up. I've already referred to this, and it's a very individual thing. Some have to have a black coffee in the morning, a cigarette. Some have to talk to their wife, to their husband. Some have to bring their children to the kindergarten. Some have to jog around the block, take a walk, meditate 10 minutes, whatever. It depends. It's very, very individual, and you have to find out for you and yourself, what does bring me here in my comfort zone to perform well, and to start the day optimally to perform optimally and perfect, and as close to the zone, probably in the zone already, we introduced at the slide before. Then you trade, okay? That means nothing more. You trade, and only that. That means you have a preset rule. You know the strategy is profitable. You know how to enter it, enter the trade. So here's the entry point. There's the stop. There's the target. You just enter the trade, and that's it. And you try, or at the end, if you're unconscious competent, especially if you reach this point in your trading, you don't make any judgments anymore. It's only a trade. If it's a winner or a loser, it shouldn't affect you from a mental perspective. The thing is, if you take such a judgment of a trade, then it makes it more likely to step into one of the described tripping hazards, so-called cognitive biases we want to introduce. So cognitive bias, for example, loss of vision, where we played this game with A and B, those two games then. At the end of this trading episode, let's call it, you document the result of the trade. You write it down, but not only that, not only where you entered the market, if you were affected by slippage or whatever, but what you're, but not only that, but also your feelings, your emotions, unusual occurrences like slippage, for example. And you write all this down in your trading journal. And it's, in fact, only a purely quantitative step. The qualitative steps, they appear later, okay? After that, you evaluate the trade, okay? The trade, for example, did it take place in accordance with your trading approach? Did you follow your rules to make it differently, or to formulate differently? Was it technically correct? Was the win-loss in accordance with your calculations? Did you face slippage? Were the news events like the ECB, whatever? Also, or did you, this is probably more important, did you reach your self-set goals? At the beginning of each trading day, you should formulate non-monetary trading goals. It shouldn't be, I want to make 100 euros today, but we know that it's a long-term journey we're taking here. So it shouldn't be money related, because this is then again capable of putting you in a state of emotional instability, let's say. But what you should have in a game with uncertainty, and where you do not know when you start the day out where it will end at the end of the day, will the market give you some money or won't the market give you some money? You should have non-monetary goals. And these preset goals, you should find out whether you approach them or not. For example, I followed my rules accordingly, for example. And then I usually end the day, in my case, and then I, for example, go to the gym, or I spend some time with my kids or with my wife or whatever. I talk to friends. And there's some distance then between this step, the evaluation, and the analytical step here, where after I let some time pass and created some distance between me and the trading, I ask myself questions like, what new insights can I take into my next trading session then? For example, improve the trading warm-up. So try to be more relaxed when entering the day. Relaxed, what I mean by that is in a mentally stable and near to the / into the zone. How can I get there? And what I recommend you is this. This is a daily trading routine, which is probably already summing everything up. If you want to try this, you can do this by following this how can I say that? You can follow this by following these steps here. For example, you have a strategy. We'll introduce one. Next week, you get one on the DAX. The week after, you get one on the S&P. And after that, we'll look into behavioral finance. If you have the strategy, you make 20 trades with the suggested setup in a demo environment. You record the results accordingly in your trading journal. Then you review and analyze it. You calculate, for example, the hit-loss ratio of those 20 trades, the payoff ratio, and then you filter out areas which are causing underperformance. Then you start to improve. How can I get rid of those identified mistakes? You implement the change, you repeat, and you start over again. 20 trades is very simple because it's 1 month. It's a 1-month process here if you want. And you do this over and over and over again. And once you reach the level of unconscious competence here, which means through repeating it over and over again, it becomes completely normal and part of your daily trading routine. You already started with one step in direction of your overall profitability in your trading. So, and now let's conclude here. I've already seen it. I'm running out of time. Unfortunately, it's such a fascinating topic. I already said at the beginning that I feared that this would happen, but let us just conclude here. Profitability in trading is built on 3 columns. We learned this already now. Risk money management, trading psychology, and trading a proven profitable strategy, so a trading strategy with an edge. And we know that trading psychology here plays a crucial role since emotions are crucial for your trading performance in a positive but also in a negative way. But emotions are crucial, and we have to remind that, or remind us all the time that this is the case. And mental stability in trading results out of following a daily trading routine, which has to be followed since it becomes natural. So once we reach the state of unconscious competence. And yeah, with that, I'd like to say thanks for your attention. And you can here now see the last slide. Where do we have it? There we have it. So for more analysis education, please visit admiralmarkets.com. I hope you enjoyed the webinar, and I'd really appreciate to welcome you again next week then. Trading Spotlight on Friday, again, 1 p.m. London. Yeah, so that's it from my end. All the best, and take care. Talk to you soon. Bye-bye.